Hey everyone, this is Robert Kientz with GoldSilverPros.com, and today I have a very special interview with Nick Barisheff, who is the president and CEO of BMG Group Incorporated. In 2002, Nick launched BMG and BMG Bullion Fund, which is Canada's only eligible open-end mutual fund trust that purchases equal amounts of gold, silver, and platinum bullion. Nick has a 20-year background in the precious metals and previously was a fund manager in the real estate investment trust area. Nick and I discuss many things on the interview, including the direction of the economy, the effects of the coronavirus, the precious metals, the stock markets, real estate investments, and much more. We believe you'll really enjoy this interview, so stay tuned. So your funds, are they, understanding the storage part, what about the funds? What types of funds are they?
So the first fund that I started in 1998 is a gold, silver, platinum fund. All our funds are only bullion. So the first one's gold, silver, platinum. Money comes in, we just buy equal portions of those metals. Then we've also got a gold only and a silver only fund. It's the kind of thing that we've explored. Getting a similar fund done in the States, but in Canada we got 6 exemptions, and all the lawyers we spoke to advised us that we would never get those exemptions in the States. So it can't be done as a public fund in the States, and it can't be done as a public fund in Europe. They don't allow any bullion in a public mutual fund at all.
Yeah, that's interesting. Why don't they allow bullion in public funds? Why has that been taken out of?
Who knows? It's that was one of my biggest underestimations of the marketing difficulty. Is that there's almost like an irrational bias against bullion by the mainstream financial community, and it's reflected in the regulators and so on. So that's been the struggle. I've made numerous presentations to the regulators here, and it's like talking to a wall.
I guess what they're wanting people to do is go into things like the GLD and SLV, which obviously don't have redemption rights for the average investor. And I think there are questions from a lot of observers over to how solvent those funds actually are. I don't know if you had an opinion on them.
Well, I'm just completing a very lengthy article on ETFs and generally and specifically on the GLD and SLV. And the missing part by most people is the fact that the bullion that's in those ETFs is leased bullion. Mm-hmm. They don't buy it. There's no way that a JP Morgan or a Goldman Sachs goes to the market, buys bullion for spot price, gives it to the GLD at net asset value. They get creation shares at net asset value, and they sell those shares to the public at net asset value. Not going to happen.
So
they borrow the shares. They borrow them. They get the shares. They sell the shares to the public and keep all the money. And people think it's about management fees. Not about management fees. It's about keeping all the money. And anyways, I'll send you an article because I've analyzed the prospectus and the authorized participant agreement and so on, and where the GLD is most detrimental to is the mining companies because it doesn't affect the supply demand and is deflecting a huge amount of demand into what people think is physical bullion. It's suppressing the price and it's negatively impacting the mining companies. And they're the ones that are funding the World Gold Council.
Who's funding the World Gold Council?
That's right. All the mining companies pay a contribution to the World Gold Council, and the World Gold Council is the sponsor for the GLD.
So why don't the gold mining companies question the GLD fund itself?
Well, the issue that unfortunately with most miners is they have a mindset that they go into the jungle, they look for gold, they find the gold, they go back to Vancouver, raise the money, dig up the gold, and sell it. They do not understand that they're creating a monetary asset in competition with the Federal Reserve. They don't consider gold any different than copper or zinc, and that's a generalization. Obviously, there's a few people that get it, but most of the miners do not understand that they're digging up real money.
So if we look at the landscape of different investments that your average investor may look at for gold, it's going to be the GLD type investment. They're going to look at various gold miner indexes, and that's
right.
But in none of these cases are they investing directly in gold and silver.
That's right. So the reason I set up the funds originally was for because in Canada at the time, this goes back to 1998. There wasn't any method to invest in physical bullion in the registered retirement accounts. So for most of the ordinary people, that's the only kind of investment money they have are the retirement accounts.
Mm-hmm.
So that's what I set up for that, and that took us 4 years to get all the exemptions from the Ontario Securities Commission.
In setting up these funds, do you have to have any special licenses, or can anybody try to attempt to set up a fund, or what is the legalities around that?
Well, because it's a security, you need to be licensed as a securities dealer, either a full securities dealer or a limited market dealer. Like in Canada, for accredited investors, we have limited exempt market dealers. So you have similar structures in the States.
I was looking at an article you wrote, I believe earlier this month, understanding the current investment reality.
Oh yeah, right.
And you were talking about the returns of gold compared to the broad market sector. Year to date, I think it was January through March. Can you talk a little bit about that? What are you seeing there?
Well, when we have conditions like this, gold is the only thing that performs. Like nothing else is working, and this is where the safe haven attribute of gold comes in. The thing that people miss right now is that when we have conditions like this, there's no rule that says you always must be invested. And right now, being invested is like catching a falling knife. So the wise strategy, which is what our hedge fund is you move 100% to gold. That's like going to real cash, and then wait for the market to finish correcting, and then you redeploy the gold, your profits in gold, into the other asset classes, and then you end up with a diversified portfolio with asset classes that you've bought close to a bottom. So it's kind of very, very simple, but very few people actually do that.
Yeah, when I have been charting gold since 2000, it's beaten all of the major stock market indices, including the Wilshire, with reinvested dividends, which really is what a lot of generalist investors do, is they invest in dividend companies or reinvest those dividends. They calculate their returns, and that's their long-term retirement strategy, at least active traders, not necessarily people that are in 401ks. But gold has beaten even that index. It's beaten the broad market. So why do you suppose gold is not getting more attention since 2000, being probably the best returning asset class?
Well, there's like I say, a big psychological barrier to it, because most portfolios are 60-40 stocks and bonds, including pension fund portfolios. And there's 7 asset classes, not 2. There's stocks, bonds, cash, commodities, real estate, and precious metals and collectibles. And if you want a diversified portfolio, you have a portfolio with some allocation to all of it. Like the advisors that deal with high net worth clients in Europe, part of the portfolio is collectibles. And a lot of collectibles have dramatically outperformed the equity indexes, believe it or not.
Mm-hmm.
But that takes a certain amount of skill, and it's not for the typical financial advisor. But everything else they can buy, and even in the case of like real estate investment trust, that's simple enough to buy. You can buy it like a stock. They've been around for 30 years. Yet there's very few pension portfolios that have them, very few retail portfolio that have them. So they're missing gold and real estate in the portfolios.
And that's what we focused on a personal and a family level is arable farmland, ranch land type of real estate, not rental properties. We did run a rental property business for about 20 years in Dallas, and in 2018, I think I saw an overheated economy in the credit bubble, so we went ahead and sold out. So we're basically cash, gold, and farmland, essentially, and it's really served us well. I sleep at night. I don't worry about it at all. I'm not worried about, the coronavirus.
Well, that's like a perfect mix for the time being. But the thing that happens there's two areas where there's a huge opportunity to buy low, and that is real estate investment trust and mining stocks.
Mm-hmm.
So both of them are relatively thinly traded compared to equity. So what happens when there's an equity meltdown like we have now? They take a disproportionately higher hit, both mining stocks and real estate. And mining stocks take a hit even if the gold price is rising. If you look at mining stocks in 2008, you'll see that phenomenon.
Mm-hmm.
So what happens is they're disproportionately undervalued and become terrific deals to buy at the bottom. I always use an example of in Canada we have an office REIT called the Dream Office REIT, and it has $12 billion of Canada's best AAA office buildings. It went down about 84% in 2008, and the dividend yield was 30 at the bottom because the rental income didn't change.
What would be your view on real estate given coronavirus? Do you think that the lack of jobs is going to affect the real estate market?
Well, the real estate market is going to be the next really big bloodbath because we've never had my background is I used to be the manager of the investment division of LePage before I started BMG. And the thing we've got now is when you look at retail office, there's a lot of real estate where the tenants can't pay, won't pay, and will go out of business, and there'll be no prospects for new tenants. So the real estate is going to stay vacant for a long time, and I think that the value of it will go down to where it'll sell at below replacement cost, because if you're going to buy any kind of commercial real estate, you're going to sit with a lot of vacancy for a long time.
Yeah.
And even the same thing applies to residential. In the residential, the question is what the government will do to give the tenants a break, and the landlords still have mortgages to pay. So that's not going to be a good deal. And real estate used to be the fallback, in my mind, the asset category that you would buy. So what you're suggesting that you're doing in terms of land is one of the things that should still work. But any kind of commercial rental property is going to be a bloodbath like we've never seen.
Yeah, unfortunately, I agree. And how bad that's going to be really still largely depends on how the governments open up the economies. I guess we're close to 20 million additional unemployed here in the United States. I'm not sure how it is in Canada, but I can't imagine there not being an absolute...
No, it's about It's about the same, but see, there's so many businesses that before the coronavirus, the markets were sitting on the edge, and there was going to be a stock market crash anyway. That was coming because we were sitting in a triple bubble of real estate, equities, and bonds. And I've been in the business 45 years, and there's never been a simultaneous triple bubble. So we had a triple bubble that was going to pop anyways, but the coronavirus made it much worse. So now we've got situations where so many companies, if just take a small example, the restaurant business, that are teetering on the verge of bankruptcy and will never come back. So if you own a commercial plaza that is meant for a restaurant, you're going to be sitting empty for a long, long time. So no matter what the government does, you're not going to have customers come back. The restaurants that'll be open will be operating at 25% capacity, and you just can't make money at that. So that's just like one sector, and there's all kinds of them that are in that kind of a position.
So what's your outlook for the precious metals going forward? Do you give specific price targets, or do you just have a general view on where they're going to go in the next few years?
Well, I wrote a book about 5 years ago. It's called $10,000 Gold. That I sounded like a lone wolf in the wilderness at the time, but now that's becoming a conservative estimate. I think we'll see $3,000 gold by year end, and then it'll keep going up. The amount of money the Fed has printed just to have people not work. So when the coronavirus is over, they're going to have to inject a huge amount of money to set things right again. And the price of gold is correlated to U.S. debt. So the more money the Fed prints, less the dollar is worth, and the more that gold is worth. There's estimates like Jim Rickards that talk about $40,000 gold.
And I think he's comparing it to, if I recall correctly, either M2 or M3 created.
That's right, yeah.
So I guess, what are your thoughts on, my thought on the stock market is we're going to have another crash, because I don't think it's just retail or the airline industry or hospitality that's being affected. I think with the layoffs, you're going to see all markets affected, because you're going to have less consumer spend at the same time that the consumers had a lot of debt. And then if you translate that to the amount of debt that the corporates have, if they're getting less sales, it's hard to service that debt. It seems as though we're going to have some sort of bond default or bond crash broadly, maybe not only the United States, given the way the banks are all intertwined. So I think that we're set up for a bigger crash here. Don't know exactly when it's going to happen, but want to get your thoughts on that.
Well, I think we're going to, the next leg down in the crash is going to be bigger than 1929. And what happened in 1929 is that you had the crash initially. Then there was a recovery of about 50%, and then a 70% crash for the next 3 years. So we're going to have something like that. We've had an initial crash, a recovery, and now what's coming is the next leg down, which will be the biggest leg. And just like 1929, investors got euphoric that the bear market is over, good times again, and so on. And they got slaughtered. And the same thing that's going to happen this time around. We're not nearly the rise in the equity markets makes absolutely no sense given the level of GDP and unemployment. So it's going to correct to meaningful levels.
Yeah, and who knows what that'll be. I was looking at technical charts of the S&P 500 here in the U.S. the other day for an article I wrote, and it looks extremely overbought, but the downside is just tremendous, and I think that it reflects not only coronavirus, what's happened the last year, but what's happened since the Great Recession. The fact that since 2008, 2009, we printed more money, and there were the stock buybacks from the corporates, but there wasn't necessarily the growth. There wasn't the profit growth. There was a lot of debt growth. So I mean, the downside to a lot of these markets is just tremendous, and it's just going to be, I think, breathtaking to watch as it happens. I think a lot of people, who don't study economic fundamentals and just put their money into markets are going to be really surprised.
But we've also got like a huge pending problem. Like in 2008, it was the Lehman crash that accelerated things. Now we've got two banks, both Deutsche Bank and HSBC, that are teetering on the edge, and both have gigantic derivatives positions that are intertwined throughout the entire financial system. So if they go down, there's not enough money in the entire European community to bail out Deutsche Bank.
Yeah, I know that's been part of headlines the last 2 years is what's happened to Deutsche Bank. And if they were to go down, how that would reverberate around the banking system.
Yeah, it'll be like Lehman times 100.
Have you heard recent developments about Scotia? I think I just saw something on this yesterday where they're going to close down their precious metals trading division. I know they were heavy into the futures markets. Do you have any view on them and their role?
Yeah, that we've dealt with Scotia for the last 20 years, and that was a surprise to us, and as well as the Scotia staff, all the staff and executives that we deal with. That was a big surprise for them. So that's going to put a dent into the market because at its peak, Scotia was doing 4 times the bullion sales of all the other Canadian banks combined. Mm-hmm. So now taking them out of the business, and their main reason that they did the volume was that they developed over 20, 30 years the ability when a mining company gets to the point where they're ready to go into production and they need to raise capital for to purchase equipment and infrastructure. Scotia would arrange a gold lease to them. The mining company would take the lease, sell the gold, buy the equipment, and then repay the gold out of production. So it was like doing covered calls. Mm-hmm. So that system worked well, and as a result, Scotia, for providing the infrastructure construction, would get the rights to sell all the mine production. So they had a large volume of bullion coming in. So that's going to have a big impact on the physical bullion markets.
Well, it's certainly interesting times right now. I don't know in my lifetime I've ever seen anything like it. I've lived through the tech crash, of course, the recession in 2008, and basically after that I got out of all of the general stock market and went into gold and of course the land. But I don't know in my lifetime that I've seen anything like it. I know my parents grew up during the Great Depression. My father was in World War II. He was in the Navy and he was part of the D-Day landing, and I think that was the last generation that's seen any tribulation maybe close to what we may see in the next few years, at least in terms of economic issues. It's I think, I don't know. I don't know what to compare it to in my lifetime, but it just seems like we're setting up for something that impactful.
Well, I think it's quite possibly going to be, worse than the Great Depression and the 1929 crash, because even before the coronavirus, that things were getting pretty well set up for that in any event. So with the coronavirus, it's made things much worse.
Nick, thank you so much for your time. I appreciate it. It was good speaking to you.
Okay, great talking to you, Robert.
Okay.